All right, Peter, going to spotlight you. And then in just a couple of minutes, I will let you know when I hit broadcast and we'll be good to go.
Sounds good.
Since we're early, Peter, I'm just going to hit broadcast and let people start filtering in. So doing that now.
We're going to give this a moment or two for more people to filter in and join us, and then we'll get underway very shortly. All right, we'll get underway. Good morning, everybody, or at least if you're on the East Coast in the US, as we are. Good morning. I'm Peter Rothstein, the president of NECEC. As you can see on the slide behind me, our motto is about being the partner in the clean energy economy here in the US Northeast. We're very glad to have you with us today. This is our 6th annual Cleantech Financial Innovation Summit, which is sponsored by NYSERDA, the New York State Energy Research Development Authority. In this event, we have been increasingly bringing larger groups together, clean tech and finance business leaders, as we're doing for today's session, which will include both the keynote and these opening welcomes and 2 panel discussions that are aimed at exploring some of the latest clean tech financial innovations, looking at different types of models for capital formation, for capital deployment, for dealing with risk, for evolving the roles of banks, of developers, of lenders and others to deal with the importance of accelerating clean tech innovation and clean tech scale up, but including financial innovations is a big part of that effort. We'll be looking at clean energy projects and discussions on encouraging and incentivizing financial systems to unlock investments in climate innovations, growing those climate solutions deployments, and creating green jobs. This will involve multiple forms of capital for risk management for clean energy projects, and we'll be touching on areas of new technology, regional and global syndication networks and portfolios, different models for partnerships, enabling clean energy deployment and operation, and new energy services, business and financial models, all part of growing a connected and efficient clean economy. Kate, if you could take a second and put up the next slide. Our agenda today has these 3 major segments, this opening and welcome, which we are in right now, and we'll have a bit more of that in just a moment. There'll be two panels following us that bring together different aspects and different models around risk capital, around deployment capital, scale up, and the strategies involved with some of the leaders in the Cleantech financial innovations areas. So stick with us through these panels. But first, I'm going to bring us back to where we are right now, the welcome remarks and keynote speaker. I'm very pleased to be able to welcome and introduce Flor Faure, who's a new member of the NYSERDA team, is the Climate Finance and Insurance Lead Program Manager at NYSERDA. It's wonderful to have NYSERDA's collaboration and partnership with us. Flor will take the floor in just a moment to briefly share NYSERDA's financial market goals and strategy dealing with climate change and related financial risks. And then she'll also introduce her colleague from the New York Department of Financial Services, Nina Chen, who's going to share some of New York State's leadership goals and efforts related to financial risk and climate change from the perspective of DFS, who is a state regulator of banks, insurance firms, and other financial institutions. NYSERDA and DFS are increasingly working together, so it's particularly valuable at this point in time to have both Flor and Nina joining us. So with that, I'll turn it over to Flor Faure from NYSERDA. Flor, you can turn on your microphone and I see you on the screen.
Perfect. Good morning, everyone, and thank you, Peter, for the introduction and for convening the 6th Cleantech Financial Innovation Summit. So as you mentioned, NYSERDA is a proud sponsor of this event, as we see the New England Clean Energy Council as a key partner to drive the clean energy industry forward. NYSERDA is one of the leading agencies implementing the New York Climate Act, setting up one of the most ambitious climate targets in the country. As a quick reminder, 70% of renewable energy by 2030, 100% zero emission electricity by 2040, and 85% reduction in the greenhouse gas emission by 2050. As you all know, climate change is accelerating, and we believe that cooperation among all the actors, from climate tech entrepreneurs to the private sector to government bodies, is necessary to our collective success going forward. The finance and insurance sectors play a critical role in financing the transitions to a net zero economy and ensuring the resilience of our communities. That's why NYSERDA and the New York Department of Financial Services signed a memorandum of understanding last September. DFS and NYSERDA intend to accelerate the creation of innovative insurance and financial products to speed up the development and deployment of key low carbon technologies by providing technical support, regulatory guidance, and facilitating as well market access. NYSERDA Innovation Team leads multiple programs that focus on transferring and mitigating risk associated with the deployment of climate technology. Beyond these initiatives, we have ambitions to help shape new programs that will catalyze investments from the finance and insurance industries to accelerate the deployment of low carbon technologies. To do so, we will leverage the thought leadership and cooperation made possible through our partnership with the DFS. So I'm proud to introduce Nina Chen, who will be our keynote speaker today. She's the first ever Director of Sustainability and Climate Initiative at the New York State Department of Financial Services. Nina previously was the Nature Conservancy's Director of Conservation Investments and had a career in finance span across a wide range of areas. So Nina received her PhD in chemical engineering from the MIT. And now I leave the floor to you, Nina.
All right, good morning, everyone. Thank you very much for the kind introduction, Flor. I'm very excited that now you are with NYSERDA to lead this important work. And also thanks to Peter and everyone at NECEC for inviting me to speak to all of you. Just to give you some more background on the New York Department of Financial Services, or DFS for short, We supervise and regulate activities of nearly 1,800 insurance companies with assets of about $5.5 trillion and more than 1,400 banks, banking and other financial institutions with assets totaling more than $2.9 trillion. DFS also supervises 4 private pension funds and 8 public pension fund systems, including the New York State Common Retirement Fund, the New York City Pension Fund System, and the New York State Teachers Retirement Systems, all are among the largest public pension funds in the US. DFS missions have 3 components. The first is ensuring the safety, solvency, and soundness of our regulated banks and insurers. The second is ensuring fair access to financial products by all. And the third is to support economic development in New York. Our climate strategy supports all these 3 components. We became the first US financial regulator, state or federal, to create a comprehensive climate program that includes the supervision of banks, insurers, consumer protection, and economic development. So why would a financial regulator care about climate change? The international consensus is that climate change poses a material risk to the financial system. Therefore, it's fully within our mandate as a financial regulator to make sure our regulated entities stay safe and sound in the face of climate change. I need to make it very clear that our mandate on the supervision of banks and insurers is about making sure they can pay their depositors' money back and can pay their policyholders when insurance claim happens. It's not about mitigating climate change. Granted, what we expect of our banks and insurers to do from the safety and soundness perspective could indirectly help with mitigating climate change. So how do we ensure our banks and insurers stay safe and sound in the face of climate change? Last fall, we issued formal communications to all New York insurers and banks, establishing a set of high-level expectations that they start integrating the financial risks from climate change into their governance, business strategies, and risk management processes, and to start developing their approach to disclose their financial risks from climate change. This March, we issued for public comments our proposed guidance for New York domestic insurers on managing the financial risks from climate change. We are the first and only US financial regulator that has established such expectations. For this audience, you might be more interested in the second component of our mission, consumer protection. This February, we sent a letter to the banks subject to the New York Community Reinvestment Act, or the New York CRA, that they may receive credits for CRA for financing activities that support the climate resiliency of low and moderate income and underserved communities. Although no one is spared from the impact of climate change, it disproportionately affects LMI communities, perpetuating social inequality. LMI households on average face a higher energy burden than other households, spending more on gas, electric, and heating fuels as a percentage of household income. It's estimated that if low-income housing were equally energy efficient compared to the average US home, energy costs paid by low-income households would decrease by 1/3. Yet many LMI consumers face barriers to such improvements, including lack of access to financing for energy efficiency upgrades. In addition, LMI communities tend to be more susceptible to flooding and heat waves, which are exacerbated by climate change and have fewer resources to recover from natural disasters. This is both an environmental justice and social justice issue. So in this industry letter that we sent in February, DFS provided examples of activities on climate mitigation and adaptation that may qualify for credit under the New York CRA. They include financing of renewable energy and energy efficiency for affordable housing to reduce utility payments for LMI tenants or for community facilities. Examples include installation of solar panels, geothermal heat pumps, and battery storage, improving building envelope insulation and lightening windows, appliance upgrades. Also, community solar projects that provide energy to an affordable housing project or a community facility that has a community development purpose. Another example is microgrid or battery storage projects in LMI areas with high flood or wind risk, thereby reducing the risk of power loss due to flooding and high wind. We also recently published a report that analyzed the transition risk in the investments of New York domestic insurers based on their 2019 year-end holdings. We found that New York domestic insurers investments had meaningful exposure to carbon-intensive sectors. Compared to what's needed to reach the Paris Agreement, insurers underinvested in renewable power generation and hybrid vehicles, but sufficiently in electric vehicles. The report pointed out one way insurers can mitigate their climate risk is through investing in issuers whose business support the low carbon transition. Finally, as Flor has mentioned, we signed the MOU with NYSERDA to support the clean energy deployment. And stay tuned for that development. Now we have Flor leading that work. Even though my department does not have the mandate to mitigate climate change, I'm very excited to see the technologies and businesses that NECEC supports and the investments that the speakers of the conference represent. The transition to a low carbon global economy is both inevitable and accelerating. I'm grateful for your work and encourage you to support LMI communities in your work. Thank you very much. I'm open for questions.
So I'll ask if anyone in the audience has a question, they can put their question into the Q&A box. And Nina, maybe I'll just ask a first question to get us started for a quick minute, as we just have a couple of minutes here. How is the collaboration with the MOU between NYSERDA and DFS enabled you to be able to tap into some of the expertise in NYSERDA and in the industry as you think about how to categorize and how to quantify the type of climate risks that exist out there for the financial players you regulate?
Yeah, that's a great question. And the work that's described in the MOU is actually just getting started, with Flor coming to NYSERDA a few weeks ago. So, but definitely we have had very close collaboration with state agents in general. For example, NYSERDA and John Joshi from NYSERDA a few weeks ago spoke at one of our events on clean energy financing, and more than 100 attendees registered. So that was for our community and regional banks. So after we have established this high-level expectation that I described earlier about assessing and managing the climate risk, community and regional banks have reached out to us, expressing their interest to learn more about how they might get into clean energy financing. So we put together this webinar to introduce a few ways they can get started and the resources out there. And I said it's been a great partner on that. And I definitely see the feedback from the webinar was very positive. And so definitely see there's more that we can do together. And the point that you mentioned about how to assess climate risk, I think that's also a very important one, especially on the physical risk side. On the transition risk side, I mentioned that we just published this report, and you can look at that from the investments and based on the sectors, it's relatively easy. But on the physical risk side, it's quite hard. You have to have geolocation data and so on. So I do look forward to seeing what's coming out from the startup communities on tackling that.
And I'll ask a question. You mentioned the Community Reinvestment Act and the importance of benefits for low, moderate income community members, participants, and residents. And clearly, one of the major drivers, I think, for clean energy and climate investments in New York State, and for that matter at the federal level in the U.S. right now, is to look at benefits for the environmental justice and disadvantaged communities. How do you look at the ability to actually measure those kind of impacts, because the banking sector has had Community Reinvestment Act rules for a long time. So maybe that could help inform the broader environmental justice types of tracking and measurements that are going to be needed.
Yeah, so we are the, besides being the first in setting the expectation on the financial risk aspect, we're also the first and only US financial regulator that has set the expectation on the CRA front. After we have issued the letter, there were a lot of interest from the federal agencies from other states that have their own CRA reaching out to us to learn how we did it, what's our thinking. I know the Fed is thinking hard on how they might revamp the CRA. There's a whole effort of revamping the CRA right now. And I would say it's still pretty early in terms of measurement. We, before the CRA, this CRA letter was issued, there were only 2 projects directly supporting climate resiliency that had come to us from our entities. And we hope to see more. So in this letter, we didn't establish new rules. We really just highlighted what's already permitted and encourage our entities to do that. I think, so we look forward to see in this year's cycle, if we're getting more of this, more submissions. Before we issue the letter, we did reach out to banks getting their inputs on this, and they are excited to see that we're coming out with this expectation. Of this
that's great.
Encouragement, I say.
And how do you work with counterparts in other states or at the federal regulatory side of things, where many of the financial institutions are regulated?
Yeah, definitely the collaboration, the coordination with other agencies very important to us. Our regulated entities make it very clear to us that they don't want to see inconsistency. At the same time, we are the leader in this space. We're the only US financial regulator that has established these expectations. So we are active on the insurance front, on the National Association of Insurance Commissioners. We are very active in the climate risk and resiliency task force, especially in the disclosure and the solvency work streams, encouraging other states. We're also active in the Conference of State Banking Supervisors. Our superintendent, Linda Lacewell, was just elected to be the chairman for the District 1 at the CSBS, the Banking Supervisor Conference. So we're thinking of how to support other states in developing the capacity. We are very lucky that in my department, we have both banking and insurance. And obviously, New York is a financial center, so we have the ability to fund my position, for example. I know a lot of smaller state supervisors don't necessarily have the capacity, so we want to share our experience and our toolkits and so on. And we also have been in close contact with not just the Federal Reserve Board, but also the SEC, the FHFA, all the big soup that you can think of. And I would say the federal agencies are also very interested in learning how we got started, what's the industry feedback so far, and how they can move forward. So I think we are fortunate to have the strong leadership. Now my superintendent Lacewell is, as well as our governor, in moving this, moving the climate agenda forward, and we want to help others on this as well.
Great, thank you. Well, as we wrap up this portion of the event and your keynote, first of all, Nina, I want to thank you very much, and thank Flora as well for your comments, your insights. Maybe one last brief question to you is, we've got a number of speakers following in these next 2 panels. What's your message to them about the opportunity of collaborating in New York?
New York is open for business, and I would say the net zero transition is inevitable. And I think there's a lot more education that you could do with your customers, with your banks, with your financing partners. It's really important work and hard work. So I appreciate all of you putting the effort into this and for your dedication.
Absolutely. Thank you, Nina, very much. And we look forward to collaborating on many areas as we move forward.
Great. Enjoy the rest of the day.
Thank you. So with that, we started to use the Q&A, the question and answer box right at the end of Nina's keynote. But I first want to say thank you to Flor Foray from NYSERDA. Thank you to Nina Chen from the Department of Financial Services, both in New York State. As we move ahead, you will see the Q&A option at the bottom of your screen. As we go through these next two panels, feel free to ask questions during those panels as time permits. Panelists may answer your questions directly, either through the Q&A box themselves, or as it's relevant to the discussion of the panel. We look forward to continue the collaboration as we're digging into these topics. And with that, we're going to switch to the first panel. I'd like to ask the panelist, Alfred Griffin, who's the Senior Managing Director and Head of Generate Credit at Generate Capital, and Chris Black, the CTO at HockettHuck Capital, Jessica Bailey, the co-founder and CEO of Greenworks Lending, now part of Nuveen, and Jon Jonsson, who's the CEO at PKA out of Denmark. All of you can put on your video and your microphones as well. Great to have you all here, and we will get this panel started. Each of you has what I consider to be a relatively unique, innovative business model / financial model of the type of capital you bring together and the type of capital you deploy and the roles that you play in your projects through that deployment. And I think this is a great lesson of the kind of innovation going on around financing and why it's so important on managing climate risk, but investing in climate solutions and the jobs, economic growth, and economic transition that goes along with these climate solutions. I'd love to have each of you take 2 or 3 minutes as we start here, introduce yourself and your organization a little bit, and just say a little bit about the core of what it is that you do and the kind of clean energy financial innovation that is core to your strategy. And Alfred, let's start with you.
Okay, thank you, Peter. Pleasure to be on this panel with the other panelists, and always look forward to any CEC conversations. Hello to all the participants that are zooming in to this. It's nice to be able to discuss what Generate Capital is up to. So, Generate Capital is a one-stop shop for those entrepreneurs that are at the leading edge of the infrastructure revolution, creating sustainable and clean energy infrastructure. We seek to be a one-stop shop. We seek to be flexible, long-term partners to help you build businesses and deploy clean energy assets around the country. We have a very long-term relationship model. We have a permanent capital structure. We can be your financing partner forever, and that's really what we want to be. So we think we are unique in that regard, and through our creativity and flexibility, we can work with entrepreneurs and energy services companies and developers to provide the kind of capital they need at whatever point in time they're in terms of the growth of their business and the scaling of the deployment of assets. So we can provide equity capital, preferred equity capital, debt capital, and combinations thereof. And we tend to have a lot of focus on the more innovative, newer frontier deployment strategies that support sustainable infrastructure. And I'm specifically helping to lead the Generate Credit effort, which is a business unit of Generate. So I'll be focused primarily on credit products and providing financing to other owners of assets. So Peter, that's what we're up to and where I'll be spending most of my time.
Great. Thank you, Alfred. Lots of opportunities for the Generate model, I think, to become a partner with some of the other folks here today. And so Chris Black from HockettHuck Capital, why don't you do your introduction here?
Thanks, Peter. Hello, everyone. Thanks for calling in. It's it's an honor to kind of participate with the rest of this group in talking to you today, and look forward to any questions you have. So Chris Black, Huck Capital, a partner at Hockett. Huck is an investment firm that is focused on energy innovation and utility transformation. So to kind of accelerate the new energy economy. What that means is kind of bringing together kind of next generation technologies. A lot of those technologies that already exist today, but are really kind of sold in these kind of one and done models. Solar guys just selling solar, and storage guys just selling storage, and maybe only one segment of the customer base, maybe just residential or just C&I, and trying to be more of a holistic provider, kind of accelerating those technologies together to solve a lot of the kind of the problems that we're seeing with the traditional generation and transmission model. So we provide growth equity capital. So work with kind of mid-stage companies that are doing really interesting things in the space to bring them together to kind of help solve that that kind of a problem of moving away from kind of the legacy distributed generation model into kind of more centralized generation model into more distributed generation and models. We also work with traditional infrastructure capital providers to do kind of the bigger kind of project work, and I'll talk a little bit more about that later on. But I think it's a super interesting time to be having this conversation. I think there's never been a time kind of more urgent and imminent to be kind of talking about these kinds of things and bringing these both capital solutions to the table and technology solutions to the table. So appreciate the opportunity to talk.
Thanks, Chris. Great to have you here. And Jessica Bailey from Greenworks Lending.
Great, thanks, Peter, and thanks for everyone joining for our Zoom conference here. Hopefully one of the last Zoom conferences. Hopefully the next year we'll all be back in person, but welcome a chance to talk to you guys a little bit about Greenworks Lending today. Our company was founded about 6 years ago, and we are one-trick ponies. We provide financing to commercial building owners who want to upgrade their existing building, or to developers who want to integrate sustainability into their new developments. So we lend through state-based programs called PACE policies, Property Assessed Clean Energy, only on the commercial side. So we make loans for things like solar and HVAC, windows, roofs, really anything a building owner is going to do to improve the value of their building and drop the energy consumption of their building, we can finance. Our model is a warehouse to securitization model. So we hold these loans, we are the lender, we hold them on balance sheet, and then once we hit a certain number, we securitize the cash flows, but maintain all of the ownership and servicing in those assets. So we really function as the soup to nuts lender for our counterparts. We are currently operating in about 25 states across the country with a team that's sort of spread out doing sales and origination across those geographies, and a headquarters here in Connecticut where we do all of our underwriting, servicing, asset management. The news on our end was that back in April, we were acquired by Nuveen, which is the asset management arm for TIAA-CREF, which is a large $1 trillion asset manager with a big focus on sustainability. So it was a really nice fit for our company, which is a mission-driven company, to find a home in a large asset manager that's going to allow us to fuel the growth that we see as possible in this industry. Think through new product offerings that we might want to start distributing through our sales channels. And think through innovation and where the kind of next wave of clean energy lending is going to go. So it's a very timely panel, and I'm happy to be on it with you all.
Great to have you here, Jessica. Thanks. And Jon Jonsson, CEO of PKA from Denmark. Thank you for joining us. You win the prize for the greatest distance, certainly.
So thank you, Peter, and thank you for organizing this conference and for having me. Just a few words on PKA. PKA is the third largest pension fund in Denmark. We are a small country, but by 5.8 million population of 5.8. My members are primarily health and social workers in the healthcare sector, and they have, of course, a very strong focus on returns and high pensions. But if possible, they would like to do good in the world while they do their investments. It's been a very value-based crowd, and it's been it for years. We have $55 billion under management and have already invested now 10% of our asset base, $5.5 billion in sustainable finance. We have done it for more than 10 years, and we have primarily investments in wind and solar farms, both in Europe and North America. And currently we have 7 investments in the US, in California and Texas. And we are now trying to scaling even more. Actually, at the Climate Summit in New York in 2019, the Danish Premier Minister and the Danish pension funds together made a pledge to invest $50 billion in in climate and sustainable finance investments. And so we have to scale, but it's also important to say that for PKA, investments has to be, it's not philanthropy, it's good business, and it's doing good at the same time. Just 3 short messages from me as an investor. So what we see now is a large influx of new money. So it's hard for us now to find projects with a sort of a attractive return risk relationship. But so we're looking for new projects, not only solar and wind, but something related to the other sustainable finance investments. Then also the subsidies of the US support sort of the tax equity partner. It's a bit different to Europe, where you have sort of a contract for difference, which is more interesting for us as a long-term owner of the asset and the long cash flow. And then just one last thing, that there's sort of a undersupply of parties willing to make long-term agreements with us. And we need the long-term agreements because we are a pension fund. So happy to find new partners in the US. We have a lot of money we need to invest. So thank you, Peter.
Jan, great to have you here, and I think you're teasing us with a few different areas where there's great, I think, good opportunities for follow-up. And I will just remind all of our listeners, excuse me, feel free to put questions into the Q&A box. And I do think that there's actually, I think a few of you have already touched on areas where I think there's some overlap, but I think a question or two that would be interesting to dig into a bit more. I think some of you are talking about dealing with larger projects. Some of you are supporting investments in smaller individual implementations, and then some of you may be dealing with the portfolio and syndication of groups of investments and projects as a way to create packaged investment and markets. I'd be very interested to hear each of you in whatever term what turn you'd like to go in, because I am interested in having conversation about these things. What do you see related to those opportunities of either starting with smaller projects and investing there, or aggregating into portfolios, or being the partner coming in with these larger amounts of funds to be deployed and with conditions for tracking in a special category? Who'd like to kick that off? I think I'll ask Jessica.
I thought you might be coming for me. Yeah, happy to jump in here. I think one of the things in the commercial PACE space that we've seen is that for quite a while, it was really not a capital problem, but more of an origination problem. And so I think everyone who knows the kind of credit quality of commercial PACE loans agrees that they're good, right? They're AA, sometimes even AAA rated credits because of the way they sit on the property tax bill with a senior lien ahead of all of their encumbrance. It's collected through the property taxes. It doesn't extinguish. So from a credit perspective, the capital markets have always said, yes, give me more of that. I think where we've seen the sort of slower growth over the last 5 years on the commercial PACE side that finally kind of broke free about 2 years ago was on the kind of market awareness side from the commercial real estate market. So we think of ourselves as having kind of 2 stakeholders. One is the commercial real estate owners that we want to bring our product to and sort of convince them that this is a good way to finance upgrades or finance their construction. And then the capital markets, who ultimately we had to convince that the credit quality is there and the kind of secure cash flows are kind of a nice ESG yieldy investment for them. And for a long time, the first part was harder than the second part. But it's sort of transitioned. I think we kind of moved maybe about a year and a half ago, out of what was a little bit of a liquidity problem for CPACE, where even though the capital markets liked commercial PACE loans, they couldn't get the pricing to where we needed it to be to kind of sell it on the commercial real estate side, because there just wasn't enough of it. So if you liken it to kind of CMBS or some of these other markets that we get compared to, you've really just got to have enough volume for it to be a liquid asset where the capital markets pricing can come down a little bit lower. And we finally crested that wave, and it took a while, right? And so that kind of aggregation, Peter, that you were talking about was really critical for us as we were building not only our company, but really the industry, right? When we were getting the first couple of loans through, when we were getting the first couple of states turned on, when we were seeing new applications of commercial PACE lending, we had to take some risk, right? We had to figure out a way to sort of incubate and warehouse these loans until there was enough of them to bring them out and say, hey, look, the rating agencies agree. These are high quality credit. And then the sort of cycle that we needed to see started happening.
And maybe Johan, I'll ask you to jump in. I'm not sure if the real estate sector as a category is one that aggregates into models that could work for a European pension investor, or whether there's how you see that marketplace. What does it need?
We are a large real estate investor locally in Denmark and have some investments also in Europe. But for us, I would love to travel to New York again, and I would love to travel around to northeastern cities, of course, and to meet all of you. But still, it's important for us to find sort of a long-term partner or a few long-term partners that can aggregate these type of investments, because we would like to invest like $215 million US and up at a time at least, because it's complicated if we stay here in Denmark and the investments are in the US. So we have to find partners, and we have to find quite big investments from the beginning. So some type of aggregator is important. I'm also very aware of that currently what we see is that the sort of traditional solar and wind projects the returns are really diminishing. We really have to look for new types of investments. And we have committed not only to the Danish state, but also to our members that we will try to invest as much as possible in sustainable finance. So we are very much looking for, whatever opportunities are possible, but we need partners, local partners.
Alfred, why don't I'll let you jump in on this as well. I mean, where do you see some of the opportunities from the generate credit side that might pick up on what Johan or Jessica were talking about?
Yeah, thanks, Peter. And I think we in terms of the generate approach, our theme fits in nicely with what both Jessica and Jan have expressed. To Jessica's point, in PACE, there was no lack of capital. Certainly, at least in concept, capital is almost unlimited for great PACE transactions now. But in the early days, although at least from my perspective, although it was a great vehicle and certainly interested capital providers out there that thought it sounded good, actually getting those capital providers to support newer entrepreneurs was, might be easier said than done. And I know Jessica, and her team put in a whole lot of work to build a business and demonstrate they could actually deploy substantial amounts of capital where you're at the $250 million north kind of numbers that John's referring to. And there's a gap, there's a market gap there. That's a chicken and egg equation where there are enormous amounts of capital that seek to find investment opportunities in these markets, but they tend to be at the largest financing organizations in the world, whether it's insurance companies or pension funds or the large global banks that really need to do multi-$100 million transactions to make it worth their while. And there are many very important business models and great entrepreneurs, and I would certainly put Jessica in that bucket a few years ago, that have great ideas, a great strategy, super credible, but don't yet have that kind of scale. And where a primary generate focus is, whether it's being an asset ownership partner, an equity provider, a debt provider, is finding those parts of the market that we view as credible, economically viable, scalable, with strong management teams, and providing that capital to enable them to scale. And with the goal being to be in the hundreds of millions of dollars in deployment with these partners that then really crowds in the most liquid sources of capital around the world to support these markets.
Yeah, I would just maybe
Go ahead.
piggyback off that, Alfred. I think one of the things that we learned early on was don't let the perfect be the enemy of the good when you're building. Like we sort of, when we were getting started at Greenworks, it was really clear where this asset class would go. And so the instinct is to try and get there as soon as you can, but actually you can't, right? You can't just start a company and then go down to Goldman Sachs and say, hey, give me $1 billion, we'll deploy it in pace. And if we had done that, our credibility would have been completely demolished because, of course, we couldn't deploy $1 billion in commercial pace back in 2015 when we were getting started. And so we had to put together what ended up being, imperfect long-term, but perfect for the moment structures that allowed us to prove the concept, test, iterate, course correct. And there are different pockets of capital all along that kind of life cycle of a company. So the first money you get in the door, it's not going to be Goldman, it's not going to be Bank of America, because they've got to move huge dollar amounts. They've got to move it in very, very risk averse ways. And you need the flexibility. If you're building an industry and you're kind of the first pioneer in it, you need the flexibility of a smaller partner that's going to understand that, what you told them you're going to do in January may have changed a little bit by April, and not, completely tank all of the covenants you've signed on the loan agreement.
I want to let Chris jump in on this too, because I think as you were talking, Chris, about distributed generation, distributed resources, where does the building and real estate category fit there?
Yeah, I mean, we're a little different in that we invest in companies, or we buy companies that do projects and across both residential and commercial. But the reason that we do that is the same, right? It's we are all struggling with the scale problem. We're all here talking about this moment in time and how much need there is, but yet there is still no such thing really as scale, right? If you look at solar, residential solar is at kind of 4% penetration. EVs, everyone talks about the hockey curve that's coming, but yet most people know 1 or 2 people that own an EV, unless you live in the Bay, and then everyone owns an EV. But so I think we see this this coming, and the reason that we invest where we invest is because we want to help accelerate this coming. So the question to real estate, absolutely, it's a huge channel, both commercial real estate and residential real estate. Getting these solutions into more hands and reaching scale is absolutely part of our strategy. It's why we invest where we invest. But I kind of echo a lot of what you're hearing here, is that it's fascinating to me that everyone agrees how much demand there is, and everyone agrees that we're at this kind of tipping point, but yet scale really hasn't started. I think that's both kind of exciting and sad, right? We see all of the outages, we see all of the the weather, extreme weather related events. We know we have solutions, but yet the solutions still aren't in enough hands, both kind of commercially and residentially.
So maybe carry on with that a little bit, Chris, for a second. As you think about the kind of scale that you hope to be investing in this decade, I think this decade of the 2020s is a critical one to actually start seeing scale happen, right? So right. What would that look like in terms of the Huck capital model?
Yeah, great question. So we see the main inhibitors to growth and kind of real scale is that it's kind of the when the only tool that you have is a hammer, everything looks like a nail problem. That there are too many folks trying to solve one and only one problem, and the kind of the natural inhibitors to solving those problems are hard and expensive. So, for example, solar, finding a new solar customer is roughly a $4,000 cost of customer acquisition. It's the most expensive part of the solar value equation still. Then you spend all that money, you land a customer, you get glass on their roofs or on their the roof of their building or in the car park, and you basically never talk to them again. Whereas that is a great customer for an EV fleet, or all sorts of other things that that piggyback on that electrification journey that customer just started. And there's too many people fighting for the same customers, with a single value kind of proposition. And so we see a way of unlocking that, I think, is removing a lot of those barriers, using technology. It's fascinating to me that some of what we're talking about are the most technically sophisticated products you can buy, right? So solar technology is amazing, to convert photons to electrons and pipe them into the grid is amazing. Electric vehicles that you can drive 300 miles in is amazing, but we sell them in the most analog ways. We still are selling solar door to door, and setting up kiosks and hardware stores, and so I think the real problems are these things that can be solved with technology, the right application of technology. So we're trying to invest in bringing those things together so that you have more of a one-stop shop of kind of completing that electrification journey. You have these moments that matter. If you become a solar customer, you're probably a really great candidate for an EV. If you're an EV, then you start feeling guilty about having a coal-powered EV, and therefore you want glass on your roof. And so I think we're trying to bring those things together to have a holistic journey, but then use technology to solve all those core inhibitors that kind of getting these things penetrated at higher scale. So that's really the core focus of our firm.
Mm-hmm. And maybe I'll turn this back over to Jon for a second. And what I was as I was listening to Chris describing their efforts at Huck Capital to, in effect, create a scaled market and market model for a category of distributed solutions. Does that create a market with the kind of risk management that would work for a global investor such as PKA?
I think normally when we do this asset class in PKA is sort of a low risk asset class, and we have, of course, high risk investments as well. But the distance does make a difference for us, of course. How can we control the asset? How is the partnership built up, and so on? But as the normal investments that we are doing is sort of drying out. It's getting really hard to get that type of investments. Of course, this is something that we have to consider. But somehow we need to have a sort of a long-term relationship, a partnership, and we might also have to have other parties in this. It's a quite complicated process of building up all the legal work around an agreement like that, hedging off different risk components. And we've done that for solar and wind, and it's taken several years. So we would have to do something similar. But of course, I mean, this type of investments are interesting for I think investors in the US and for investors in Denmark. We just need a way to structure it. And we have set up a separate company several years ago and asked other Danish pension funds to join, and we are now a few pension funds, just to have the right competences and sort of the people that can actually see through these type of investments. Because from my view, I have $55 billion to invest. I have to look into all different kinds of asset classes. So we set up this separate company to have the right competence to do this, and we would have to set up extra people to look into investments like that. But I think it's interesting, and it's something that we have to look into. Could I just add, from a European perspective, the US is very interesting because the transition you have to go through in the US is enormous, also compared to Europe. So if I look into wind farms, offshore wind farms in Europe, at least in my part of Europe, we are filled up almost. It's wind farms all over the place. We have them in the UK, we have them in Northern Sea, and so on. So, and the transition that is ahead in the US is very interesting, and it's an enormous market for us to invest in.
No, that makes a lot of sense. Another question or two, actually, on some. One of the areas where I'm hearing lots of opportunity from, I think, each of you is around the kind of partnership opportunities. that would open markets, bringing different level of expertise from different partners, but to enable these markets that need to approach ways to scale and attract larger scale sources of financing. Would love to hear any of your thoughts about, how do you think about who the key partners are that your organization looks at, and whether they're aggregators of projects, whether they're the owners, whether they're the off-takers, whether they're the developers.
I'm happy I'm happy to jump in there. And I know this is going to be a topic later, but I can't go without mentioning the role the public sector plays in all of our markets, right? So I think of, the kind of demand generation for what we do, which is help building owners upgrade their buildings. There is, I don't know, 20% of the early adopters are the folks that got the EV, and then they have the solar, as Chris is talking about, that are kind of motivated because they care about these things. But 80 and frankly, probably closer to 95% of folks make those decisions because they have to, right? Because either they've got a piece of equipment that's died and they need to replace it, and it's smarter to do something that's got more energy savings over time, or the government is mandating it, right? And so you're starting to see real movement on kind of building owner behavior as it relates to some of the laws coming out of New York City and Local Law 97, and sort of pushing essentially a carbon tax on real estate, which is quite unpopular, but when matched with attractive ways to finance those upgrades is at least palatable. We're seeing the same thing in Washington, D.C. and California, and frankly, Massachusetts has been a leader on this for quite some time. But there is the need in some ways for a stick to drive the demand that allows those of us that are innovating financial products to help transition the energy economy to move us a little bit faster. So I think of one of our key partners is the public sector. And, we've been on the commercial PACE industry side of the fence here. We've been thankfully sort of insulated from some of the federal policy back and forth over the last 5 years. But with Biden coming in, we aren't seeing, Trump wasn't able to kind of shut us down, which was great, and didn't have too much of an effect on what we were able to do around the country. But with Biden coming in now, you do see almost like a mentality shift of people being like, oh yeah, like that's right. We were supposed to be thinking about this, and sort of a return to some of the global treaties and a return to attention on climate change. And it's as though like the country sort of like shaking the head and be like, oh yeah, like that's right. Obama was talking about this. Now we're kind of picking it back up. And it feels, at least like from a kind of mental perspective, it's leading owners, even without a policy stick, it's leading building owners to say, okay, the world is still moving in this direction, even though we sort of had our head in the sand for 4 years.
Thanks, Jessica. Who else wants to jump in on this? Chris?
Yeah, I mean, I think we have an interesting example of this. We are invested in a company called Greenstructure, which is a joint venture between Schneider Electric and ourselves. And Greenstructure is basically a microgrid energy as a service business, and it's super interesting in that, especially given kind of all of the more intermittent problems that are occurring with extreme weather events and the outages and all of that being able to control your own destiny a little bit as a company, generating a little bit more of your energy and controlling more of your energy mix is becoming more and more important. But to do that, traditional microgrids are extremely expensive, extremely complex, and and that's okay for larger kind of C&I customers. Because they have the balance sheet that can afford it, but for the smaller C&I customers, they really haven't. And so Greenstructure is super interesting in that it's kind of an as a service business. So we would go into these kind of 0.5 megawatt to 5 megawatt commercial customers and design the microgrid, drop it in it's a mixture of kind of solar storage, gen sets and whatever kind of needs to be done to meet their kind of load profile. And we do it as a service. So we would sign like a 20-year energy services agreement with them. It's a fixed price energy. It's usually 10% or more cheaper in the in the outer years or across the term for them than buying their energy from the grid. They're more resilient, all those kinds of things. And because it's kind of as a service, they're just paying a fixed price. But that means it has to be done on someone's balance sheet. So we do it on our balance sheet. We build these microgrids for these these C&I customers, and then we transfer those assets, and once they're kind of up and running, to more of an infrastructure player. So we just did a deal with Blackstone ClearGen, who's bringing $500 million of capital to that to the table here to kind of take ownership of those assets, and that kind of is good for everyone. That allows us to really focus on getting more scale of these microgrids, doing these as kind of drop in, kind of as replicable as possible across as many businesses as possible, and then kind of bring the capital to kind of take those assets and run them and own them longer term. So it really is good for everyone, but I think it's a great example of a partnership where they bring that kind of capital that they're really good at. We bring the kind of capital for to allow the companies to really grow and scale, the growth capital, and the customer ends up winning.
And specifically, to make sure I'm understanding the model, Chris, you're packaging up a portfolio of these operating microgrid as a service types of businesses, so they can be multiple projects of a type.
Exactly right.
Mm-hmm.
Exactly right. Yep.
Yeah. So maybe Alfred, that there's some synergies there between what Chris was just describing and the generate credit efforts. Why don't you take us through that a little bit more?
Sure. Well, I think I agree. There are synergies, and to your point earlier, Peter, in terms of partner type, for generate, whether it's partners and aggregators or developers, technology companies, energy service companies. You mentioned PPA off-takers. We would think of those in generate speak as end user customer types. All of those are partners in ways to scale, and you can think about like, for example, municipalities that may be looking to transform their bus fleet to electric fleet vehicles, and leasing solutions that might be provided there. Financial partners. I think Chris has referenced they have a great financial partner in BlackRock. Financial partners, wherever they may be along the capital structure, are an important partner. And at Generate, we seek to be able to be a capital provider for businesses that need sort of early scaling capital, maybe more equity-like capital in terms of scaling their business, across to debt solutions, as you're scaling and have a more creditworthy construct. So at the end of the day, to be able to offer a full suite of products, or have partners like Chris has to offer that full suite, is an important part of the mix in helping these businesses scale and grow.
Very helpful, thanks. I wanted to remind the panelists, if you have a chance, take a look at the Q&A, where there's a number of questions from the participants. If there's something you want to be able to answer live as part of this panel, feel free to let me know and jump in with it. Yes, Jon.
Yeah, there's a question around CFDs, or contract for differences, and how do they work in Europe. So what we saw is that back in the early 2010s and 2011, the Danish government set up sort of a state guaranteed CFDs, or sort of a band. So it could be no worse than this. And if it was better, it was not good for us, but it gave us the confidence to do the first investments and to develop this, and have developers doing them, having off-takers, so they sort of guaranteed the off-take price. And in many ways, it kickstarted something that was very strong and it was very good, because now in Denmark, most pension funds have an investment around 5 to a little more than 10% of their asset base in sustainable finance. And we have Vestas, sort of a huge wind farm constructor. We have now also Ørsted. I don't know if you know them. I think they are building around close in your area, offshore wind parks and so on. And all of these companies have started from these CFD schemes put out by the Danish government. And we're just a small country, so in a way, we were developing something that was maybe a whole set of a whole industry that sort of are participating at the upper level in the world right now. And so I think it's a way also to go back to at the state level to ask them to help, because it's really changing. So what we're doing now is the next phase is Power to X, and the Danish government is now trying to formulate something similar. And I think that's also going to be very interesting, because then, you know, wind and solar panels are sometimes working when you don't need the power. And if you can change that into Power to X and maybe use it in large container freight ships or anything else, ammonia and so on, we have something very interesting coming up, and a whole new investment phase, which is something that we're looking into. Just to say that it all kickstarted by the state at the state level.
Yeah, I think there's a lot of similarity with what's been going on in the US, but I would certainly say there's a number of areas in which we've lagged behind some of the models in Europe. And some of the models in Europe are certainly scaled sooner, but we've seen a few of our individual states in the Northeast explore contract for differences as a way to create a market a market expectation of revenue for things like renewable energy credits, RECs. And that, I think that's fairly similar, but it's also been quite interesting. Some of the same project developers you mentioned, including Ørsted, who's a member of ours, is developing wind projects in the Northeast. And I think there's going to be lots of opportunities, not only on the individual generation projects, but the infrastructure to connect that and upgrade the grid accordingly. Great points. So that's I think a good opportunity for any of you to jump in, thinking about some of the project types and the lessons, any lessons that you've learned or drawn from outside of the Northeast, whether it be from Europe or California or elsewhere around the world. This is one of those periods of time, I think, in the evolution of clean energy and the clean economy transition where we're only going to get to scale if lots of regions are really learning from each other. So if there are specific models and specific learning from around the world that comes to mind, I'd love to hear what that is.
I think one of the things that we're seeing some movement on that is exciting for us is around community solar and figuring out ways that PACE financing can help fill a financing gap there. Again, these are kind of smaller, disaggregated, as I was talking about earlier, projects that they need some scale in order to attract the low cost money, but we're not quite there yet. We sort of haven't tipped that curve. So it feels as though there's some interesting advancements on community solar here in the Northeast as well, but also in California. And then the only other thing that kind of we're seeing that we're, pretty excited about is a move for PACE to be able to finance prepaid PPAs or prepaid leases for solar. So this is sort of a marriage between two structures that have been very successful in commercial solar, and kind of bringing them together to help really kind of non-credit worth, or not credit worth, there's the wrong word, but non kind of A-level credits access PPAs, and using kind of PACE as a credit enhancement there. So those two trends they've been picking up over the last year or so, and I think there's more to do there.
It's a little more focused on the Northeast, and Peter, my experiences in New York State from having had the pleasure the last 7 years of being with the New York Green Bank, which is a division of NYSERDA. I would say certainly one of my learnings there is that by being close to the policy teams at NYSERDA and the governor's team, good policy matters. And there can be entrepreneurs and financiers standing ready to build assets, but if the policy framework and the regulatory framework is not in place to be able to create transparency around how developers and entrepreneurs can create value from the assets that they deploy, there aren't going to be assets to finance. And had the pleasure over the last 7 years to see excellent policy be implemented, and sometimes that had to be a few iterations just to get it just right, but then see really markets take off. And community solar being an example of a market that was created, started at zero and is now hundreds of millions of dollars in the state of New York, just in a 2 or 3 year time period, where policy really makes a difference.
Chris, you want to jump in?
No, I don't think I have much to add. I was going to also comment on community solar as the example there. I think we need more favorable policy in more states in order to see the same thing as we're seeing in New York, because it's absolutely a fantastic alternative for a lot of people who don't have better options, and in fact, it's often the best option. But there's just not enough of it, and getting more of it is too slow and too many hurdles in too many states. So I would just second that.
Great. Well, I think I'd like to expand upon this last piece by thinking about the federal side in the U.S. And for any of you thinking about how we make sure that the U.S. market really does start to scale, thinking about what's missing, or what is the main opportunity that you hope the federal government will provide. Is it around policy? Is it around certain sectors, buildings or storage, or modernizing the grid, or the way the regional markets are regulated? Or it may be actually the federal government coming forward with certain kinds of capital that could unlock some sectors.
Yes.
All of the above. That's right.
Any first choices if you could only ask for one?
I think for us, it's probably more on the policy side. As we just discussed, I think that's the kind of thing that can accelerate these things. I think there's ready capital out there, as we've discussed today. There's ready consumers of all types. I think removing the hurdles to allow things to kind of get at scale and proliferate more quickly, I think is the best way of kind of getting to the kind of the end game. So for my vote would be kind of simplifying the frameworks and loosening some of the regulatory constructs. And obviously a lot of those are there for the right reasons, but just making it easier.
Jessica, you want to jump in?
Yeah, I mean, I think that's right. I mean, as I said earlier, I think just the sort of signal that there's a transition happening helps for our business, because people don't want to be kind of left out or left behind. So I think, policy is important, policy is slow, but the idea that policy is pointing in the right direction, I think is an accelerator for our business for sure.
Jon?
Well, the long distance, I think I better hold a little bit back on this. I'm not sure I can put out what is the best, because I would need some partners, local partners to talk to. But what I can say is that in Denmark and among my fellow CEOs, we are very happy of the new way that the US are working together with the rest of the world in joining the Paris alignment, the Paris Agreement, and so on, and also the policy signals on a very high level to really invest in this. I think that's maybe the most important thing for us, because for us, we are long-term investors. So is this something that is going to just keep on, or is it just for a short while? We want to have an investing period of 10, maybe 20 years, and those signals that we're seeing now is very positive, seen from my perspective at least.
That's great. So I'm going to ask. I think we're coming up near the end of the panel. So before we formally wrap up and turn over to the next panel, I think I'll just ask each of you. I think a variation of something we've been talking about, but for For the people who are joining us to listen in and to ask some of their questions or think about how this applies to the opportunities that they're creating in the clean economy, what would you say, to help any of them think about how they could be a partner for you? If some of them feel like there's an opportunity to approach you, what's the question or a piece of advice you'd like to give them? And Alfred, I think I'll start with you, if I may.
All right. Yeah, I think the I'll play off something Jessica said earlier when she was starting Greenworks and finding capital. Be reasonable. Be reasonable. Focus on a market that has scale and has big potential, but be reasonable in terms of your expectations of the next couple of years worth of deployment and your rationale as to why you can get it done, and be thoughtful, have a good strategy in place in terms of not only why it's an attractive opportunity, but how you're actually going to convince end users to take action, because that can be sometimes the toughest part of the equation. And I think Jessica even mentioned that earlier, sort of the origination piece. The entrepreneurs getting customers to take action is easier said than done, even if there's a positive value proposition. So I think those would be critical elements. Obviously, credible team that one can have confidence that will be there for the long term and be rational and prudent and can be a trusted partner to have your best interest at heart.
Great, thanks. Jessica.
So I'll maybe take a different approach to your question. I think you were asking sort of how would folks work with us. I think one of the things that I just wanted to mention as we conclude here is that our acquisition by Nuveen is exciting for what it means for our core product and that kind of one-trick poniness that I mentioned and ability to scale CPACE. But it also offers us a lot of opportunity to think beyond our core product and think of other types of clean energy lending that we could do to help accelerate the transition to a better future. And so we're starting to think through sort of product gaps in different sectors of the built environment, but also just different sectors of the economy. So those that are on the phone or on the Zoom here, to the extent, you're seeing a place where kind of smart and specialized financial products in the clean energy space could help accelerate a transition, I'd be all ears and eager to kind of think about what the next chapter looks like for us at Greenworks.
Great, thank you. And Chris.
I think for us, we are, as I've mentioned, growth capital. So, if you are on the phone, on the Zoom and running an interesting kind of growth stage firm that is, doing, in the e-mobility or distributed spaces or energy choice, any of the kind of the technologies we've talked about that's going to allow us to get to kind of what the future looks like as far as remaking the grid and getting everything cleaner and more renewable and everything else. If you're at that stage, you're running one of those companies, I would absolutely love to talk to you. If you are a business owner, running kind of C&I and need more control over kind of your own kind of energy mix and generation, then would love to talk to you or introduce you to kind of Greenstructure. So I think we are always interested in interesting companies at the right stage of growth, that have capability and kind of the fire in the belly to really kind of capture that kind of scale. And if we can be helpful in doing that, then I'd love to talk to you.
Great, thanks, Chris. Jan.
Well, that's a tough question, but I'll try to answer it anyway. I think what we're looking for is sort of a partner that can offer an ecosystem. So you can offer project developer, operational partner, and of course also the off-taker. And if you have a long and healthy track record, that will be even better, but it's maybe hard to get in this new investment types. But at least some sort of long-term partnership is what we're looking for. And if you can offer some sort of ecosystem, then it will be easier for us to engage.
Thank you very much, Jan and Chris, Jessica and Alfred. Great discussion. I hear from all of you opportunities today, but also recognition of the complexity and the challenges, but also the changes going on as the scaling of these markets needs to take place, and I think all of you are playing roles to help it take place. So thanks for being collaborators in this session. And for all of our participants, stay where you are, because we're going to be now shifting to the next panel. My thanks to the first panelist, great discussion. And I'm going to turn this over to Alistair Pym, the Vice President of Innovation and Partnerships with NECEC, to introduce and moderate the second panel.
Thank you very much, Peter. And thank you to Alfred, Chris, Jessica, and Jan for a great first panel. So this panel, we're going to dive in, sort of peeling back the onion one layer, and look at some new tools and approaches to assessing risk, and sort of then matching capital as well to clean tech projects. So I'm delighted to welcome up, and as I do, please switch on your videos and audio, Adam Hayes, who is the Managing Director for Storage Risk Solutions at Ascend Analytics, John Selinger, who's Vice President at Orion Energy, Justin Sullivan, the Founding Partner and Chief Investment Officer for Greenbridge, and Dr. Rachel Baum, who's a quantitative strategist at Nephilah Climate. So what I'd like you all to do is to quickly introduce yourselves over sort of 2 or 3 minutes, and just explain your role in this industry, and talk briefly about the opportunities and challenges you see. And let's start in that order. So Adam, over to you, please.
Great. Thank you, Alistair, and thanks to everyone for being a part of this excellent event. We're really excited to be a part of it. My name is Adam Hayes. I'm with Ascend Analytics. We provide software and a broad range of analytics services to folks really across the clean energy sector. For developers, we work with development teams to identify attractive sites for renewable energy storage assets, do techno-economic optimization. For investors, we really support a broad range of valuation, looking at long-term revenue potential across a wide variety of market conditions. For long-term asset owners, everything from hedging strategy, design, and evaluation to integrated resource planning for utilities, and then market bidding strategies. And this is an area that we've spent a lot of time recently for both renewables and storage assets, helping asset owners determine the optimal way to participate in markets as they become increasingly complex. The growth of renewables has brought with it a lot of volatility, a lot of opportunity for storage assets, but a lot of challenge as far as determining how best to capture that. And so we see that combination of skill sets putting us in a what I think of at least as a pretty fun position in terms of bringing together our ability to forecast how markets will continue to change in response to higher levels of renewable supply, what that means for the value of renewable assets at different locations within these power markets, what that means for storage assets, and combining that capability into a role in designing and really facilitating the underwriting of new risk transfer tools that are really designed for high renewable penetration markets. I think as far as challenges go that we see, I think the events in ERCOT in February really highlighted that some of the risk management tools that exist today, especially for wind and solar facilities, aren't well designed for high renewable supplied markets. As markets become more dependent on renewables, the exposure created by the existing hedge structures can become potentially catastrophic, as we've seen. So we're looking to work with developers, really on behalf of developers, with risk management providers and low risk capital partners to design hedging structures, both for storage assets and for renewable facilities as well, that really fit the exposure that those assets face in highly renewable supplied markets. So with that, I'll pass it up.
That's a great start, Adam. Thank you. And I look forward to circling back with some questions. John, let's go to you next, and same question.
Thanks, Alistair, and thanks all for joining. My name's John Salinger. I'm a vice president on the investment team at Orion Energy Partners. We are a private investment fund. We currently have a little north of $2.5 billion under management across our various fund vehicles. And we're focused on investing into businesses with environmentally innovative business models across the energy, industrial, and infrastructure sectors. Historically, we've invested out of our main credit strategy where we are providing non-dilutive, non-control, unitranche style debt to help businesses really grow from a transition point after the stage where they've kind of eliminated a lot of the binary risks around technology or market or things like that. And before the stage where they're really ready for the big institutional capital. So from a size range, we're looking at deals in the 20 to 200 million range typically. We're also launching some equity funds this year, really focused on similar sectors, just maybe going after deals with a slightly different risk profile that would generally fit into our credit strategy. But overall, our value proposition is really giving businesses and business owners a way to grow their business in a way that allows them to maintain ownership and control of the business and participate in that upside compared to more traditional private equity models where they're taking direct ownership and control.
Great. Thank you, John. And let's go to Justin next.
Hi, Justin Sullivan with Greenbridge. Greenbridge is a value-added platform. It connects project developers and early stage projects with institutional capital and also customers. So C&I customers, community solar developers. This is an integration story. It's about providing access and more visibility to where value can be created through projects and how investments can be made over the long term to enable the energy transition.
Thank you, Justin. And finally, let's hear from Rachel.
Hi, Alistair. Thanks. My name is Rachel Baum. I'm a quantitative strategist with Nephila Climate, and we are the ESG-focused business unit of Nephila, which is the oldest and largest investment fund dedicated to reinsurance and climate risks. So we're really focused on developing our long track record over the last 20 years or so of both developing and executing financial risk structures that help to mitigate climate risks. So this is anything from energy to ag to other businesses that have climate related risks. And specifically to Cleantech, we've been one of the developers of the proxy revenue swap and other sorts of instruments that help to de-risk renewable projects and just in an effort to promote a faster transition to a low carbon future.
That's great. So I think, we heard a lot from the first panel about, there's this appetite, there's lots of money out there, but there's maybe not the sort of right sort of projects. And I read a report this morning from Canary Media, actually it referenced another report from ACOR. But over the last 3 years, I think 167 billion has been put into clean energy, but 93% of that is solar and wind. So to me, that speaks to, there's a lot of other technologies out there which are waiting to be financed. And I think all of you have touched on that topic about, how do you help these markets emerge? So what I'd like to dig into is just help me understand sort of the niche or niches that you have looked at and want to help emerge as these sort of new technologies start getting adopted. So let's go back the same order, and if anyone wants to jump in anytime, please do. So let's start with Adam. And, you said you're going to focus on energy storage, but dig a bit deeper into that.
Yeah, I guess my perspective is just that energy storage's time has come. I think right now storage lives in an awkward space where wind was kind of stuck a decade ago and solar maybe 5 or 7, in which the predominant form of revenue certainty is from a contract that leaves very little of the upside with the asset owner, whether that's a tolling agreement with the utility or an outright sale to a utility. It's kind of got this binary set of outcomes in which you retain either no risk and no reward, or all of the risk and all of the reward with a fully merchant facility. Over time, you saw this evolution in the wind and solar space, in which the technology continued to evolve. Costs fell, the energy provided by those types of facilities became competitive in the market, and new forms of financial hedging instruments emerged to support the revenue certainty of those assets. Virtual power purchase agreements with corporate buyers, financial hedges under fixed block contracts with commodity traders, and then the insurance and reinsurance products that folks like Nephila brought to the market. All these fantastic innovations that really allowed some of those hundreds of billions of low risk capital dollars to flow into that sector. Storage hasn't yet seen the emergence of those financial hedging instruments, but the value of storage across competitive power markets has never been greater. The technology is increasingly proven to be reliable and safe in most instances. The value of storage as renewables rises, it grows with it. And I think the opportunity to bring a new suite of tools that align the risks of owning these assets with the risk and reward appetite of different types of investors, that's really the nearest term opportunity. It's low hanging fruit as we see it. Down the line, as the technology supporting hydrogen production, ammonia synthesis, other forms of long duration electricity to X conversion technologies emerges, I think similar opportunities will arise with it. But the technology readiness, I think, is foundational for bringing in low risk capital.
Right, good start.
I can certainly see the value that Adam and his group bring. Having evaluated many battery storage projects over the last couple of years, we have struggled with that exact problem where it makes a lot of sense. It's solving a very clear issue that needs to be resolved, but how much is it going to make every year, and what is the right revenue number to underwrite to? So adding some kind of revenue certainty through hedging products or through offtake structures is really important, and I think that's a huge need. And a lot of that is also where our business has found a niche. I think if you narrow down what we really spend our time on, it's on smaller, more complicated deals somewhere in the energy value chain. And anyone that's worked on debt or equity deals can tell you it's really the same amount of work for a $50 million deal as it is for a $5 billion deal. And so our business specializing in those smaller deals that maybe aren't getting the same type of attention and help and pushing some of those levers to get a project built or to get a business off the ground. And it involves a lot of mitigating a lot of those binary risks and critical risks around, maybe a business has a lot of exposure to LCFS credits or RIN credits or merchant power. Finding ways to mitigate that either through financial derivatives or through offtake is a big part of what we do and kind of how we structure around a lot of these risks. Ultimately, getting a deal to a place where it is, we can call financeable or ready for institutional capital.
So talk to me a bit, John, about some of the projects you're doing. I noticed that Adam talked, not just about energy storage, but about hydrogen and ammonia. And I did see something like that in one of your case studies. So can you elaborate a bit about how you're approaching some of those new markets?
Yeah, so I'd say the last 12 or 18 months, we've been particularly active in renewable fuels markets. We have a big investment in a business, a brownfield conversion of an old oil refinery in Bakersfield, California, to produce renewable diesel. And that's a good example of a lot of that business is around the LCFS program and the value that's generated from those credits. And our team and the team at the company worked very hard for a long time to get the right offtake structure in mind, to get the right commercial partners together to make that business work. We also have an investment in a wood pellet facility, a biomass business in Arkansas, and that's a little bit of a different market. It's a smaller market where that has really got off the ground through really strong financeable offtake contracts from strong counterparties. So a little bit of a different, less structure around maybe financial derivatives and much more just in the contracts themselves. We also recently closed a deal with a mothballed ethanol refinery in Eastern Ohio, which is being restarted to produce hand sanitizer. It's a very 2020 deal. But again, one that a lot of ethanol facilities have run into some issues, but with the right commercial structure, the right offtake partner, where you're getting some kind of revenue certainty from for a higher value product than maybe just fuel grade ethanol. We found a lot of value in that business, and we're very excited about it.
Great, thank you, Justin. So going around the table, sort of digging in one level deeper. So what are you really drilling into?
So I think answering some of the questions around not only what the financial models look like for these projects, but why does this project need to exist? What value is it creating for the supporting community, for the grid, for the larger energy market? Getting down to the questions of what's the real value of the project, of resiliency, of the type of reliable or renewable, sustainable infrastructure that is asking for the investment. And I think helping those project developers to really, make those reasons the star of the show. Understanding how to contract to highlight those strengths and really mitigate concerns and risks where the story isn't as strong. But ultimately, not only are we seeing the rise of renewables and sustainable infrastructure, but this is a local story. This is when you put renewables very quickly on certain systems, it's like squeezing one end of the balloon. We're moving from a centralized hub and spoke to distributed, but that also, isn't necessarily something that happens without integration issues. So where those integration issues are present, we believe just inherently it heightens the value of storage. So how do we get the message out to say, here are the reasons why this is a great market and site selection for a storage project? And how do you bring the financing and workflow to that project to make it investable? But how do we also show the value of this project to the utility, grid operators, ISOs at large? And I think that's part of the next. I think the next leg of this journey is bringing more transparency to the value as a grid resource. When we think about energy storage or other types of emerging technologies, at their core, great technologies really should be resources for where they're co-located for the grids at large. But so far, the industry is either poor or doesn't have the visibility and the tools to value the asset across its benefit to the grid. And I believe that that's a great thing to focus on for the industry going forward, is identifying not just what an ROI on a spreadsheet looks like, but really what's the value as a resource itself. These are not two-dimensional projects; they're three-dimensional energy systems, and we should be thinking about them three-dimensionally.
So we've heard a lot about storage and a few other areas from John. Rachel, but what about you? I mean, weather-related risk can cover many things. So where's your sort of focus?
Absolutely. I think in this space in particular, it's been interesting for us to see kind of the journey from around 2012, when the first idea of coming up with, all right, how do we hedge out the intermittency risk of production and the timing of wind and solar to actually being able to do those contracts around 2015. So there's always this kind of delay between, all right, we have all these new technologies, they're always coming online. That happens really rapidly. And then we're just consistently going to see these risk problems that we need to offset. So for us, it's really, all right, can we characterize these risks? And do we have the data and analytics to do that in a way where we can then price them? And then we're better able to take those risks off the hands of the projects. So I think we saw that with wind and solar around 2014, 2015 for us with our initial product offerings. And now that we have analytics companies that are deep in the data for batteries, how we can see the value in them, that allows us then to understand, all right, how can we price these and then be able to take that risk off the hands of the project to allow them to have better financing and a lower cost of capital. And we're better suited to take those risks as we have a very large portfolio of those that we can take and benefit from the diversification. And I think that's another piece that we're very excited about when we look at different types of products like storage, where we can balance that with the wind and the solar that are already on the grid, how storage fits in, and not necessarily at the specific asset level and how that's gonna fit in maybe at the particular market and their policies, but more so just how that fits in across the whole portfolio.
So that's helpful. I think that, you know, we've focused on the clean technology, which is you want to enable and want to help, but I feel like there's also revolutions happening in the digital world and in the finance world, sort of fintech and just IT in general. Are those trends helping you, you know, give you more data, give you new tools, techniques to help you do your jobs? Adam, let's start with you on that.
Yeah, I can't count on both hands the number of times as we entered into the space, probably similar to the experience of the early days of developing the proxy revenue products, which took several years, as Rachel mentioned. How many times folks said insurance is too expensive, or, you know, people have looked at doing this for storage, it was attempted for other products, it won't work. And I think that was probably true at one point, but the quality of data, the ability to do complex analytics to really inform the underwriting of revenue risks associated with any type of asset on the electricity grid, whether it's storage, wind, solar, hydrogen, the availability of data and the ability to utilize that to take a very informed view of what the risks look like. It moves us from a very, I think the technical word is fudgy view of risk to a far more nuanced one in which we can actually characterize the exposure of these assets to events that trigger revenue exposure. And that allows folks like Nephila to bring their underwriting prowess and low risk capital to these structures in a way that makes them actually cost competitive. So I think it's extremely dynamic with, you know, the evolution of the market, as well as the ability to understand where the market has come from and where it could go.
On our side, you know, we are focused on longer term investing and are not really super active in the day-to-day market fluctuations. So I think our angle on where this comes into play is much more around really understanding as much as we can what risk we are taking based on the data that's available. And I think we want to make sure that, you know, a lot of these markets are nascent and are developing. And so as much as we can gather and analyze with, you know, an objective lens, what type of risk do we have for this type of offtake structure versus that type of offtake structure with a hedge? You know, some of those nuanced differences are impactful, and we spend a lot of time on.
So what are some of the key risk factors you're looking into then? I mean, it's not so much the day-to-day. So
yeah.
What does that mean?
Generally speaking, you know, I think first and foremost, we want to understand what the business is doing. What is the technology? You know, our focus is not on early stage technology. And so we want to make sure that we are not taking a binary risk around, is it going to work or not? We want to make sure that we can answer that question really simply and without controversy. Where we do take some, we'll call it technology risk, is using existing technologies for maybe a new process flow or a new use case. we made an investment into a data center business which uses industrial chilled water technology to increase the efficiency and reduce the power usage. So it's something like that, where it's a novel concept combining these two technologies around data center and industrial cooling, but on their own, they're very well known and existing things. So understanding that, understanding the revenue model, the risk around the offtake, whether it be physical or financial, and then some of the more technical blocking, tackling items around projects, whether it be regulatory and permits, what's the process to get an air permit, going through the EPA or going through local fire codes, things like that. Construction, what's the contract structure to get a project built, and we're developing knowledge and experience around the incentive structures that work and those that maybe that don't work as well and are more controversial. Site control, operational risks around owning and operating these businesses. Most of our team has experience operating energy assets and has an appreciation for some of the maybe nuanced or ongoing challenges that may exist in the power markets or the renewable fuel markets or things like that. So we focus on a broad range of risks, and I think price and historical volatility is one among many.
Right. So you talked about markets there, and I think we've seen how markets can be upended pretty quickly, as happened in ERCOT in Texas. So who wants to tackle a question? How do you deal with something like that? Because you've got to take into account market risk, and the market's not designed to tackle this kind of thing. How do you price that in? So Rachel, maybe, do you want to talk about that?
Sure, I can jump in on that. I think, right, we all experienced the chaos of February in Texas. And yeah, a lot of these risks, I think, were known to some degree, but a lot of the modeling and the severity of them were not captured. Obviously, it was a very specific confluence of events that led to what happened. But I do think on the modeling side and understanding the risk, this is where we do kind of have to think about, all right, the system itself has changed dramatically, and it's going to keep changing very, very quickly. So how do we keep up with that, one, from a data and modeling perspective? And then two, how do we think about that when we're pricing this? And then I guess a third point also is, how do we design contracts that better fit this new risk that we're able to characterize? So that's where we sit now, and we think about, okay, these bank hedges, no one wants fixed volumes to go along with the variability of renewable energy. So how do we kind of come to an agreement where we say, all right, we can't just do as you generate, because we need to have this consistency across the grid, but then we also can't do fixed volumes because that's not how it's produced. So we think about that more across the spectrum of, all right, we can come to an agreement somewhere where we have, we are trading off those risks, and then we can set limits on some ends for the counterparty of where they want to be able to capture some of that upside. Like Adam was mentioning, going fully merchant is not really palatable to any lending group. And so how do we let them capture some of that while also offsetting that risk from our perspective? So I think that's where it's been interesting to see how new modeling has come out, how people are definitely trying to stress their models to capture more of these extreme events, and really just be a bit more forward thinking in terms of the structure of the grid and what can really happen, rather than just looking historically at what has happened.
Okay, good approach.
Yeah,
I would
just add that, it also comes back to understanding the system design in a market and where the incentives should be for the betterment of the whole ecosystem. So if you have a market like ERCOT, where they have not historically had the same sort of paying forward for resiliency or reliability in the form of advanced payments or insurance, well, as renewables came on, there should have been higher incentives for black start plans, right? And so creating an awareness of what's happening at the system level, you then incent the developers to go either add black start to existing plants or new builds with Black Start. Different types of resiliency can be valued if you understand kind of what the overall system architecture needs to de-risk it. And I think that where today there's still limited visibility in a lot of our energy systems and markets, that is a barrier to the ideal types of grassroots development that could be happening. With better information, you can better incent. Doesn't mean you have to destabilize or increase risk over understanding how a system works. It merely means that you can better value a new project and the attributes of that project.
So are you so if you want to make it more transparent, are you using new technology to do that, or are you changing the way the game is played?
Yeah, I would say like things like understanding where congestion occurs within energy systems would be a good start to better understand what the value of projects could be. Congestion is like, it's like diagnostics in healthcare. Understanding how overworked a substation or transmission endpoint would be could help better value a system versus just two proposals submitted in completely different areas of the utility system supported by the same declining block tariff. We're not getting very far there. I think if you add sort of incentive adders for solar tracking or hybrid, that's a start. But if you really want to make a difference, you're taking those things and putting it together with very localized understanding of how it benefits the system.
So this reminds me of what Alfred said. I think, you need good policy. And I think that some states have tried to get the utilities to open up and be more transparent about some of those things, where a new project can benefit the system. So
yeah.
Where do you...
And it's not, I don't mean to interrupt. It's not just, this isn't, a utility, hasn't shared this. It's also that the tools in order to value this, right? They have to meet together. It really, I'll go back to what I said. I believe this is an integration story. There are unknowns historically in terms of, exactly where these points along the grid are that would most benefit from third-party capital investment. But at the same time, there's a lot of unknowns in counterparty risk in C&I, commercial and industrial credit sphere, right? So it's about bringing visibility to all of these things. And that's where the private market is really good. I think the private market has always been, it's what is the problem, give visibility to the problem, and then unleash, the creative abilities of entrepreneurs to go solve it.
Okay. So that sounds exciting, but sounds like there's a lot of hurdles to overcome. So what is it going to take to really speed it up? You mentioned transparency, but aren't you going to need the public sector to step in and change a few things as well?
Yeah, definitely. I think, better defining, better defining, where the rewards are increased for system benefit, right? I think that is a great place to start. Okay. So it's not a developer versus utility story. This is definitely not that. This is a, give the system an ability to value the project higher. Create a marketplace. Marketplaces work. And so I think that public sector participation in developing a marketplace for higher value distributed energy, sustainable infrastructure projects is sort of a must, right? If we're talking a lot about hydrogen and things like that get mentioned, that's an emerging technology, but in the hydrogen projects I see, they better be located near transportation networks. So the idea of where projects should be, sure, you can capitalism is good at failing as well. And we can have a long road to these emerging technologies getting a foothold. But I think it's a lot easier if there's collaboration early in the process to what determines the value, and that helps drive site selection, and that helps drive third-party investment, and ultimately it scales adoption.
So I'm going to take a leaf out of Peter's book and ask the question about, are you seeing best practices happening somewhere, maybe in another continent, maybe somewhere in the US? I mean, you've all got visions of where this market's going, but is it already happening somewhere? And you point to it and say that would be good if we could scale that up. So, John, you were nodding.
Yeah.
Let me start with you.
I'll take that one. I think just at a high level, what's most important about policy implementing change is stability and clear goals of the program. Two contrasting examples of that would be the federal renewable fuel standard and then the California LCFS program. The LCFS program in California has a really clear goal about reducing the carbon intensity in the transportation fuel in the state of California. It's been around for a while. They keep extending the sunset date to a really long runway. It's been really consistent about the rules of how it operates, the value of the credit, the general marketplace, like Justin mentioned. And as a result of that, projects are getting built pretty consistently. You're seeing a lot of renewable diesel or renewable natural gas or certain hydrogen projects in the light duty vehicle market around refueling infrastructure, things like that are getting built, where the renewable fuel standard was created in the early 2000s. And a lot of the goal of the program was reducing reliance on foreign oil, which post shale is not really a concern anymore. And the enforcement of the program kind of ebbs and flows with what's going on in Washington. And as a result of that, you have wildly fluctuating value in the underlying market mechanism, which is the RIN. And so if you have RINs 18 months ago were at all-time lows, a month ago they're at all-time highs, it's really difficult to deploy money into a business that has exposure to that if you just don't know what it's going to look like tomorrow, and it could really change at the stroke of a pen. Now that risk exists in every regulatory program, but I think getting back to the initial point, which is really clear goals and stability and commitment to the goals, to those goals is critical to successful implementation of those policies.
So you should be encouraged with the Northeast looking like they're going to implement the TCI, and I think LCFS is on the table as a sort of a second string to that too.
Definitely.
So that's a builder market. Yeah. Anyone else got any best in class places they would point to?
Yeah, I would just say, borrow from what's worked in the past, driving standardization through certain components of contracts, across markets is helpful. It worked in residential solar. It's worked in other markets as microgrids or kind of PPAs with other energy service attributes attached to it. But try to get, let's see if we can get 70 to 80% of that agreement with some standardization, so that all these transactions aren't bespoke. That helps drive this. What can we do to not only kind of control those controllables, create the risk management tools that are being discussed on the panel, but also some standardization and form that really has proven to help in the past, and that is typically only done with coordination across the public, the private, and the capital markets.
So I'll just pick that apart a bit. I mean, I think with solar, right? You have a panel, you have an inverter, you plug it in, right? But if your story is integration, but that integration could be many different things. Mm-hmm. Can you standardize that? I mean, have you seen past examples in other industries where that sort of Lego block approach can be standardized?
Yeah, I would think so. I mean, if what we're driving at here is, community solar adoption, things like that go a lot faster. if each community adopting it isn't hiring an army of attorneys to write the first community solar agreement, right? So this becomes supported. You know, one thing that's been done by both at the federal level, but also at the state level, is to really just post, sample agreements, understanding how organizations like the NECEC can help support the community by saying, okay, well, we have partnered with these companies who have created these string of successful projects. And, instead of just protecting the first mover advantage, there's a willingness to share how the market, was able to construct this successful outcome. Those are the types of things I think we all need to drive at. Distributed energy is too large for a winner take most market. This has to be a multifaceted integration story. There's going to be a lot of developers, a lot of stakeholders, and this should be about how to make it move faster and more efficiently versus just kind of asymmetric learnings of a few companies.
Okay, that's helpful. Thank you. I want to go back to Rachel, and you've talked a bit about where you are, but what do you see opening up in the future? I mean, we've sort of touched on a few new markets, but which markets and which opportunities do you see growing and scaling up, Rachel?
Yeah, absolutely. So I think what Justin was talking about a little bit with having more standardization, even across contracts, is definitely something that we like to do. I think it's difficult because every project tends to be in a unique situation. There has to be a little bit of catering to their needs. But I do think that we can, outline the specific characteristics that are important. And I think for us, where we see a lot of the new opportunities are in assets like storage. I think it's at a point where the technology has come down in cost enough where it becomes much more interesting as an investment for lots of people. And I think also with the data and the analytics side is where we get very excited about it. And we say, okay, we understand these things now. We have enough information where we can make informed decisions about how much risk is involved in these offtake structures. And we have our own kind of internal venture team that looks at climate tech and insure tech and is constantly updated with all the data that's available now. So I think that's really where we say, all right, we're able to marry both the understanding on the data and analytics side with the technology being available and low enough in price that it makes it a very appealing process for us.
So just storage, I mean, I'll go back to this Canary Media article I read today, right? So 93% solar and wind. Storage is definitely emerging. We've been talking about it for the last 3 or 4 years in this summit. But what about some of the new categories like geothermal, which is rising a bit, carbon capture, and hydrogen? Mm-hmm. What do you all think about those 3 categories?
I would say I'm seeing a lot of projects. The project flow coming through Greenbridge for those projects is increasing. However, what the sort of that inflection point to where we know a project is investable is still being discovered, right? And that's where I think there's a lot of market discovery that's going to happen here. Is what is how do we better define that? There's a number of projects this week. We're looking at a number of anaerobic digestion projects for renewable natural gas, doing a lot of the matching to larger energy companies with these early stage projects. But again, it feels early, and that each of these projects is very heavily negotiated at the individual project level. And just from my experience prior to Greenbridge, Alicia knows this, but I spent 16 years at GE and G Capital, G Power, and G Renewable Energy. I know what this adoption curve looks like in just previous technologies and experiences we've had in the past. It really gets to the inflection point once the market decides on a few critical elements to these projects that create real value. And we need to just all work together to get there quickly.
Yeah, all three of those categories, Alistair, I think I agree with all of what Justin was saying about it. There's a lot of motion, and I think a lot of these industries are figuring out what works. I think what excites us about geothermal, for example, is it's kind of what I mentioned earlier in the discussion, that it's using a lot of existing technology to advance geothermal's been around for a long time, but they're utilizing horizontal drilling and 3D seismic from more traditional upstream oil and gas technologies, which have real benefits to geothermal. So I think we're taking a hard look at that and see a lot of value. There. Carbon capture is one that it makes a lot of sense, but we have struggled to find a deep bench of businesses that economically can support the capital that's needed for the project. And I think what's going to bridge that gap is ultimately going to be policy support. And we're starting to see some momentum there, but it's still early days. Hydrogen's an interesting one. Hydrogen production, electrolysis has been around for a while. It just hasn't been cost competitive. So I think we have struggled to find projects on the hydrogen side that compete economically with other forms and the more traditional steam methane reformer technology in hydrogen production. But there's a lot of momentum. There's a lot of policy support around fuel cells and fuel cell vehicles. So I think it's one that will continue to develop, and as technology pushes forward around refueling infrastructure and getting into medium and heavy duty vehicles instead of just light duty, then I think there's real opportunity. But I think that's still early days there from our view.
Great. Well, we've got a couple of minutes left. So I do want to give Adam and Rachel a chance as well, if you want to comment on those.
Yeah.
Emerging.
Sure. I think all of these technologies have something in common, which is exposure to an increasingly volatile electricity system. On the geothermal side, it's a function of the value that they provide relative to the falling value of wind in a wind-dominated system or solar in a solar-dominated one. For storage technologies, it's a function of that same sort of arbitrage that emerges as wind and solar erode their own value in the market. What we're looking at is both on the supply and the demand side, whether you're electrolysis facility, a data center, a traditional retail load provider, and exposed to price volatility in producing an end product, in selling electricity to customers, or on the supply side as a generator that's exposed to falling value of your product. Understanding how the market will continue to evolve and what that means for the value of your facility. Justin mentioned the complexity of this market being three-dimensional, and I would argue that hopefully without getting too meta, that it's actually more of a four-dimensional problem. And when you think about how congestion creates opportunities for storage, the market doesn't react, or the market does react to those sort of opportunities. The market always drives towards equilibrium, and high volatility is going to induce more storage, as we've seen in Texas. It's, that storage will eat up volatility, will erode congestion in areas where it's significant, and create opportunities for more wind or more solar to come in. And that dynamism must be a central part of how we view opportunities changing over time. So I think that consideration of how the technology, the market, and the risks that different types of assets are exposed to, how these evolve in parallel, I think that has to be a central piece of the consideration for decision makers across the spectrum, from the development to the investment to the policy side of this.
That's great. Thank you, Adam. And Rachel, final word?
Sure, absolutely. I think just to echo what Adam was saying, we deal a lot with more of the weather side of the timing and production of any of these renewable sources. So that's where we are really thinking about the volatility of each of these individual technologies. and how we think about that, like you said, within this whole universe of the market, the policies, the technology itself, and how each of those individual either developers or off-takers are thinking about kind of their long-term view of what that means for their risks.
Well, thank you all. We've come to the end of the panel. I think you're all doing fantastic work. You're really pushing the boundaries, pioneering, and enabling these new technologies to emerge. So thank you for doing that. I hope you've enjoyed the panel. Now I would like to go back to Peter, and I think we're going to wrap up quickly, but thank you very much, panelists.
Thanks, everyone.
Thank you, Alistair, and thank you to a great set of panelists. I couldn't say more than what Alistair just noted about the importance of their work to clarify some of the risk and opportunities in some of these emerging markets. And that's a big part of where NECEC tries to convene different players to help share learning, share approaches, enable partnership, and be able to accelerate these markets. So great session. Thanks, Alistair. And if we can go back to some of the slides, I think we would first just like to thank all of our participants from both panels, as well as Fiore from NYSERDA, who kicked us off as part of the welcome, along with Medina Chen from the New York State Department of Financial Services for a very interesting and insightful keynote, and all the panelists from panel 1 and 2. We keep trying to do these kinds of things, and we have a number of events coming up. There's a new series that we're doing this year, which is sponsored by National Grid, and the series is entitled Connecting Regions on the Road to COP26. Looking to learn from each other across regions around the world, as the entire world is trying to make progress toward a net zero economy. We have 2 events coming up. The first one on July 22nd on cities and the built environment, and then on September 14th on clean transportation. Please join us for these, make notes of them, but also make sure you're on our mailing list, which, if you're not already, which you can get to from the necec.org website, so we can keep you in the loop on other things coming. And included in that other things coming, we just announced a save the date for our 2021 Green Tie Gala. Those of you who know and follow NECEC know that the gala goes back many, many years, and it is a live face-to-face event. We are aiming to bring it back after a hiatus in 2020 on November 18th in Boston that evening. This is the week after COP26 ends. So those of you who are based in Boston or can pass through Boston on your way back from Europe, please make a note and watch to be able to join us and collaborate and participate in the Green Tie Gala on November 18th. And with that, thank you very much. This has been our NECEC's 6th annual Cleantech Financial Innovation Summit. We will, of course, do this again, but look for all kinds of opportunities throughout the year to bring together participants in the clean capital finance areas as we look to create the partnerships to advance the clean economy. Alistair, what else do you want to add?
I think you've said it all, Peter, so I'm not going to say anything more, but just a big thank you to NYSERDA, our sponsor, and to all the speakers. It's been a great event, and appreciate everyone attending and staying till the end. Thank you.
Thanks, everybody.